Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial experts John and Michael Parise from Copper Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Parise of Copper Beech Financial Group. But we just have Michael today because, his dad's out doing something, having fun. It's summertime, so he's probably at the beach, right?
Yes, he is. And he would have loved to have been here, but he has a good friend that's in town. And so it was kind of a fortuitous thing that they were able to get together. So I'm flying solo today, but or at least on the Copper Beech side. But we've got a guest here with us today, so that'll keep things interesting for sure. So I'd love to introduce Eric Fuhrman from City National Rochdale. Eric, thank you so much for being here. Great to have you on.
That's a pleasure. Happy to be here.
So Eric, we were chatting a little bit before we started recording here. We can go in a lot of different directions, I think, with our talk today, but we had the pleasure of talking with your colleague, Ben Ludwig, on a prior podcast, kind of about who CNR is, how you guys approach managing portfolios. So for any of our listeners that have maybe not heard that first episode we did with Ben, I would encourage you to go back and listen to that, because I think that's going to really provide a really good foundation, probably for what we're going to talk about here today with Eric. But love to kind of hear, obviously we're talking to clients all the time about what's going on in the markets, and we're living in volatile times here, to say the least, in terms of whether it's tariffs or trade wars. New tax laws, as we're recording this, just went into effect not too long ago, and so our clients are really looking to us for guidance here. And I'd love to really kind of just pick your brain on how you at CNR are really approaching all of this change that's happening, and maybe just get into kind of like, where are we with kind of the economy here today. So I mean, I don't know if that's a good bridge from a starting point, but love to kind of hear, how you guys are thinking of things going forward here.
Yeah, that's a completely fair question. So yeah, thank you for having me, and happy to discuss all of this. This is a very interesting market, obviously. And, if we think about, the past 25, 30 years of investing, we've had a lot of different types of cycles that are impacted by different types of factors. And the market we're in today is definitely one that, at least in the last year or so, has been very much influenced by external factors. So we would compare, thinking about policy in particular, tariff policy, tax policy, regulation, those having the biggest impacts in the near term on market direction. And we kind of contrast that with periods like the tech bubble or the financial crisis, where those were more traditional greed and fear type price movements. And fundamental analysis worked fairly well in that time. If you were disciplined and you were adhering to some fundamentals, you could see kind of what was evolving. And if you were disciplined, again, had success in those periods. This period now is honestly a little bit more similar to the COVID period, different, but where external forces and policy responses were driving markets in the short run. Our take kind of on this now is that there's a lot of risk in both directions, to both the downside and the upside. And the way we approach our client portfolios, which is a little different, I think, than some traditional asset managers. We're a multi-asset class manager. We deliver custom strategies for each of our high net worth clients. So every client has kind of a North Star portfolio allocation. That's their long-term roadmap. And in different periods within an economic cycle or market cycle, we'll overweight or underweight different asset classes, industries, security types, depending on where we are. And in this period, given the volatility we've had, we are fairly close to neutral to our long-term allocations for the majority of our clients. Understanding that those allocations are set to withstand a multitude of market events and meet client goals from a risk side and an expected return side. And we are fairly close to those in this period, more so than in a lot of other periods.
Yeah, I mean, it's like I said, it's very lot is going on, to say the least. And so I'd love to kind of also touch on, because one thing that's I think maybe today even it's going to come out of the Fed meeting, right? So interest rates, that's a hot topic today as we're recording this. And are they going to go down? When are they going to be cut? President Trump, I know, is aggressively advocating for a rate cut. Do you guys see that on the horizon for this year? Is kind of approaching the end of 2025, or do you think we're going to stay kind of pat with where we're at today?
Our assumptions are we're working on the assumptions of a range of 0 to 2%, or excuse me, 0 to 2 cuts this year. And the reason that that's a wide range of 50 basis points is there's still a lot of information that needs to be digested. We haven't seen really much impact flow through the data from tariffs yet. Policy themselves haven't set, and reaction to those policies needs to be observed for some time. And obviously, as I'm sure you and probably a lot of your listeners are familiar with, the Fed has a dual mandate. Their mandate is to keep inflation at 2% and to keep unemployment relatively full, which is a 4 to 4.5% range typically. The unemployment side is kind of correlated to growth. So if we simplify that and think about basically inflation and growth as the dual mandates, a lot of uncertainty remains on how policy is going to impact both. And obviously, in a tariff-related inflationary environment, the recipe for that from the Fed is to raise rates. And in a slower growth environment, the recipe is to cut rates. And the Fed is kind of caught in a position like most market participants where we don't know on the weighing scale of things which is going to fall more heavily and which side policy is going to be required to offset a bigger swing from standard long-term expectations. And
right.
So markets are waiting. I think. Oh, go ahead. Sorry.
No, please. I thought you were finished. Go right ahead.
Oh.
Love to hear more.
And so right now, markets are pricing this in, and we are aligned with markets and the expectation that we're much more likely to see a cut than a raise. But the timing of that is really uncertain right now.
Okay. Yeah.
The Fed has been very disciplined. If you're going back to 2022, where we saw bond markets not pricing in the level of rate hikes that we saw to combat inflation. And also bond markets as late as March of 2023, pricing in 3 cuts at a time where the Fed was really clear they weren't going to cut until we saw close to 2% inflation. At the time, we were running at about 6. And so they didn't cut obviously until 2024. And the Fed has shown this makeup of the board has shown a lot of discipline in waiting to cut and making inflation a priority.
So how does that? So you say more market neutral. So does that impact how you approach whether it's portfolio construction or asset allocation? Is it obviously because you're managing custom portfolios? I'm sure the answer to that's probably going to vary from client to client to a large degree. But how does that topic really impact how you're approaching the management of portfolios?
That is what's leading to us to have a fairly neutral stance when we think about the balance in allocations between overall equity allocations and overall fixed income allocations, why we're fairly neutral at this time.
So
the other thing with rates, though, too, is we've seen over the last year, obviously, we've seen the short end come down as the Fed has cut, but we've seen the 10-year rise to be at a higher level than it was a year ago. So, a lot of lending obviously comes off 10-year in residential mortgages, 5-year in commercial. So rates themselves to most consumers and most businesses are in fact higher than they were a year ago. Think about actual lending.
Right. So you mentioned tariffs before, and it's kind of their inflationary impact on kind of the markets. What are you seeing in terms of impacting that? I'll shift a little bit maybe to the stock market in terms of affecting supply chains and things like that. How do you guys approach that? Are there particular sectors or asset classes that you guys are looking at more on the equity side that are maybe will fare better or worse in kind of with where we're heading from a tariff perspective?
Absolutely. And part of that is right now we're a lot more constructive on financials, which are much more immune to that. And depending on if there's more CapEx or there's onshoring to the US, there's going to be a lot more business investment going to behoove financials who are lending to those businesses. And they're obviously a lot more insulated from the tariff impact from an importing standpoint. There's no physical goods associated with financial services. So that's an area that we like. We still like technology, even though some of the consumer electronics areas like phones and physical goods will be under some pressure. We still think that the innovation cycle is early to mid, especially with regard to artificial intelligence. So we think
Right.
there's a long runway there as well. So those are two areas that we like right now. It's going to be a little bit more challenging in healthcare, particularly pharma. Tariffs are going to have a big impact there, and industrials as well. So we're just, from our standpoint, we deploy quantitative constraints, but have a fundamental stock picking team that's always looking to find the best investments that are going to be resilient, have deep competitive moats, and are trading at valuations that we think are achievable and exceedable by those companies. So we're constantly shifting our active portfolios to put them in the best position to outperform.
That's great. What about energy? How are you looking at that market or asset class from an opportunity perspective in light of kind of where we're at today?
Yeah, that's a sector that's really had a lot of cyclicality if we go back a decade and a half or so. It was a difficult place to invest in the US because you had a lot of E&P companies that were shoveling CapEx, were basically putting all their earnings back into businesses and chasing after more and more difficult and expensive to obtain resources. There's been a lot more capital discipline energy lately, and that's been an investor call. A lot of activism, or less tolerance for kind of lighting money on fire on investment in space, and the companies have gotten more efficient. So there's a little bit more attractiveness. At the end of the day, though, it's a global commodity, and global commodities are very volatile. And those businesses, especially the E&P companies, are effective price takers. So they don't have the kind of moats that other you could find in other industries. So we have a healthy weight. We're fairly neutral there right now. And again, part of that just because of the better operations and capital discipline by those companies. That's where the majority of our client investments are domiciled right now.
Yeah, so I mean, and kind of a similar asset class would be more of, I think, like gold, which is on, this year kind of on a tear. Do you foresee that continuing in the future? Or do you think we've reached a peak on that asset class from a growth perspective in light of kind of where we've at now halfway or so through the year?
Yeah, so I don't follow that asset class deeply. We don't allocate to it as a core asset class. It's obviously a fear indicator.
Yeah.
And it's interesting in a time where equities are performing very well over the last several years that gold has seen an uptick. And I think a lot of that is due to fears of global instability that we've been kind of seeing. You kind of correlate that with some digital assets as well. But at the end of the day, gold's an interesting asset class because its utility is a lot less than its actual price. And so, it's not fungible currency. It's a store. It's been perceived obviously as a store of value for some time, and I don't see that going away. But that's an asset class that's not one that's analyzable with fundamentals 'cause it doesn't generate a cash flow.
Yeah. Yeah. So Eric, how would you, I mean, if you're an investor and let's say uh, sell your business, you have a chunk of money now and you're looking to move into a different world really, but from an investment perspective, I mean, what are the things that you guys think about in terms of asking that client about how they now want to deploy this capital within kind of where we're at now? And again, your kind of market neutral outlook is it something like dollar cost averaging that you would look to, or is it a specific asset class that you would look to? Like, can you give our audience a little bit of an insight how you might approach that situation when you're meeting a new investor for the first time?
Yeah, absolutely, Michael. So we part of this is really establishing what our plan is going to be, and there's a lot that goes into that. But to kind of simplify it, we think a lot about the ability to take risk and the desire to take risk. And so how much return is needed for lifestyle, for cash flow to meet current needs, time horizon of use of assets, whether it's to actually be spent during a lifetime or it's more legacy, who the beneficiaries are ultimately, and how a family or a person deals with volatility. Because some people just emotionally struggle with downside, and we have to be cognizant of that because this
Yeah.
isn't an experiential return stream that we have throughout an investment life cycle. For So we take that all into account when developing an allocation, and we do that. We're using a lot of traditional asset classes we've been bullish on U.S. equities for the last 5 years. We haven't had a dedicated allocation to developed or emerging markets for over 5 years. And part of that has just been the way the U.S. markets are structured from a regulatory standpoint, from where the growth is, where the intellectual property is, capital, and the struggles that some other areas in Europe in particular have really had coming out of the financial crisis and their inability to kind of grow. And there are a multitude of reasons we can get into at some point on that. But for us, U.S. equities have been an area that we've been really strong on, even with this kind of snap back a little bit this year. We're still more constructive there for many reasons. We also, though, when we think about portfolio construction, we think about income generation from different assets, because that's, despite price volatility, you have two components of return. There's price appreciation, there's income return. Even in difficult markets, that income return is fairly predictable. Absent major defaults, especially investment grade side, we haven't seen a default investment grade bonds since WorldCom or Enron. Policy has really changed around fraud since liability. And we have the opportunity now to actually generate, not just mitigate risk versus equities, but we can generate a meaningful return in those asset classes now, which kind of changes the landscape for us. There was a period where we were very heavy, this is years ago, in dividend equities, because that was a place where we could generate a cash flow stream. But we can now get that from corporate bonds, from high yield bonds, from private credit. So we have a lot of tools in our tool bag to kind of meet some of those client needs. To answer your question on dollar cost averaging, when we have clients come in, we typically spend about 3 months either transitioning a portfolio, or if it's a cash portfolio, maybe an IRA rollover or something like that. Typically spend 3 months building that portfolio from day one out. And we take half positions in securities, and we're trying to be really thoughtful and methodical about when we take positions and how we move into that. We have certain levels. We'll think about equity markets. If they're more attractive, that'll be a quicker process. And if they're fairly expensive, that might be even longer process, depending on where we stand in the cycle.
Yeah, no, that's really all very good information, and I am actually interested to hear a little bit more, if you can, on kind of the emerging markets or developed international markets versus the U.S., Europe, as well as maybe China, and how you guys are positioning yourselves in light of sort of their outlook economics wise. I'd love to hear a little bit more detail on that, because that comes up a lot of, and I hear this a lot from people in your shoes, even from clients, almost as if, man, there's been such a U.S. bias in terms of, or domestic bias in terms of portfolio management. Should we be looking at opportunities on the international side or the emerging market side? Are those undervalued relative to where we're at in the U.S.? So it is a constant conversation that we're having there. So I'd love to maybe get a little bit more detail on that side of things. I think it'd be great.
Sure. And this is all situational. So as a firm, we've been in international markets before. And even in our core equity strategy, we've had holdings that are non-US, but we just haven't had dedicated sleeves the last few years. But that's more situational than dogmatic. And just like for reference to, prior to joining C National Rochdale, I spent 15 years managing global equity strategies. So I very tuned to non-US markets. But we have several dynamics that have made those markets a little less attractive to us, even if the valuations from a static multiple standpoint are fairly attractive. Europe has really struggled to grow coming out of the financial crisis. And the formation of a single currency really held them back coming out of the financial crisis. Because when you think about when times are difficult, there are two hands of policy that work to work countries or economies out of that. And it's both the monetary and the fiscal policy side of it. And Europe really, obviously, as we all kind of know, struggled coming out of the financial crisis because you had companies with very disparate fiscal situations, from Germany's discipline to kind of what's happening in Greece and Ireland and Portugal.
Yeah.
So you couldn't apply one cohesive strategy. You had to have austerity in some currency, in some countries. You could act somewhat normally in others, but you just didn't have the ability to have their monetary policy or their central bank work in concert with that fiscal policy. And as a result, Europe had a really difficult time growing out of that period. So it's a lot more challenging for them. Also, we've seen part of this is the investment in the US tech sector, but there's a lot of human capital flight to the US. We obviously have had the largest growth engine over the last 10 years, 15 years, 20 years And if you look at in the tech sector, the largest market caps in the world are located in the US. And that has been a strategic advantage to investing in US markets. And there have been times that we've evaluated going back into non-US markets, and that's on the table all the time. And something that I would expect, like, we'll be back having dedicated allocations at some point in the next few quarters, but it's finding that entry point that's difficult. We go back to 2022, there was a lot of fear with the Russia-Ukraine war that Europe, which is dependent on importing energy, would potentially be cut off from Russian oil and gas supplies. That dramatically impact the German industrial economy, you know, or face higher prices from importing from further off locations. And at that time, we saw China coming back late from COVID, and you saw energy prices spike for a while there. The U.S. is the largest producer of energy right now, and we're self-sustaining. There's a lot of advantages to being domiciled in the U.S. for those reasons. Europe also had some consumer headwinds as interest rates rose, because you think about the consumer in the U.S. A lot of homeowners are locked at 30-year or 15-year mortgages. In Europe, a lot of those are adjustable every 5 to 10 years. So we just keep seeing these headwinds pop up on the European continent that have made it much more difficult for them to keep up with growth in the US. And so from our standpoint, if we can invest in global companies that are domiciled in the US, that are, have better regulatory situations, typically have a little bit more revenue skewed here, have more energy independence, have more tech IP and access to that type of human capital, all of those have been tailwinds. And we've seen the last 5 years, even with this non-US rally this year, the US has had somewhere there 2x the return of EFA over the last 5 years, and even bigger spread versus emerging markets. So we're looking for that opportunity, but given that most of this year's outperformance has come from currency changes, and currencies tend to mean revert, this is probably not the entry point.
Yeah, that's great. And the other thing that I hear a lot about, and I think it would probably be related to what you just mentioned, is the demographic outlook for a lot of these countries, whether it's in Europe, Asia as well. And how is that factor into sort of your decision making as it relates to where you want to invest into? Because I mean, I'm sure the United States has its own demographic problems, but as I understand it, not an expert in this arena, of course, but as I understand it, we're not nearly as challenged in that department as maybe some other countries, which maybe it's a longer term issue than a shorter term one. But I don't know if that's something that you guys look at all.
No, absolutely. I mean, that's part of when you think about the calculation of GDP. It's invested capital times labor times total factor productivity. So labor stemming from population growth is a big part of that. And obviously China is reaping the challenges of their one-child policy now. And, it's been a very difficult environment for them. I know you had mentioned China earlier. It's a difficult place to invest for a lot of reasons. Obviously the population struggle is a big one. They are in a property bubble. And also the opacity of the data makes it a little bit difficult to get confidence that we're seeing, the data matches what's actually happening. And so that's a challenging place to invest. I think from our standpoint, if and when we do go back into international markets, it may be more focused in certain countries, places with higher growth rates like India, areas that we find more interest. China's a difficult place to invest.
Yeah, India seems to be, there's a lot of buzz surrounding India from an investment perspective when I talk to portfolio managers around conferences and things like that. So, that seems to be, although I think they have maybe some of their own demographic problems. I was reading an article, which I thought was maybe not as much of an issue, but I mean, are they having, I don't know if you know this, more of their demographic problems in terms of slowing population?
Honestly, not an expert on that
Yeah.
topic. So I wouldn't want to comment prematurely.
Yeah, no problem on that. Yeah.
But that's like when we all of the, at the end of the day, we're looking for growth. We're looking for regulatory stability, rule of law. All of those are factors into why you would invest in certain areas. And I think from our standpoint, may have been earlier back into non-US focused investments, but the way the election turned out, we knew that tariff policy was going to be at the forefront coming out of it. And in a tariff related world, our expectation, and we still think this is the case, is that the US loses less than other countries. So on a relative basis, makes the US stronger. And the other thing was with the outcome of the election was, well, our expectation was first half of the year, tariffs would be a focus. Deregulation and tax policy was going to be a tailwind in the back half of the year and then onward. Also, both of those being big tailwinds to US companies. So that's those are kind of adding to the reasons why we're positioned how we are right now.
Yeah, that's interesting. Well, Eric, listen, this has been a great half hour or so. Love to have you back on at some point in time. But before we sign off, is there anything maybe that you think is really important for our listeners to understand about you guys at CNR, economy in general, investing world in general? I'd love to hear maybe some closing thoughts if you have them.
Sure. I think there have been a lot of paradigms in investing that have kind of become institutional, and there's been a lot of inertia about them. I had come from a world where benchmark sensitivity, beating a benchmark was kind of the gold standard. And at the end of the day, from my seat now, we have clients, and those clients have goals, they have objectives, and those are rooted in risk and return. And sometimes that kind of take a pie, pick some managers, hope for the best allocation, I think is a little thin. And so from where we sit, we're trying to think holistically about our client, how our investments in all our asset classes interact, how they matter into that long-term plan, and being able to be nimble and adjust as markets adjust by kind of being able to see the whole picture, I think is a big difference. And I've seen a lot of client success where we've been able to adapt our allocations to their changing life cycles, to inheritances, to job losses, to buying property or receiving windfalls, and we're constantly shifting our feet for our clients and being able to think about how the whole investment picture really works for those objectives, as opposed to just beating a benchmark. I just think it's a much more forward thinking and holistic approach to investment management, which is why I made the move here. And very happy to kind of stand by that process for our clients and work with them as opposed to just for them.
Yeah, no, that's awesome. I mean, the investment world's changing all the time. I mean, listen, it's part of the territory. We have to stay on top of that stuff. But I love that term, kind of a new paradigm, because it's things changing, whether it's retail and more retail investors being able to get access to opportunities that maybe were not as otherwise available in the past. I mean, one area we probably maybe not in your expertise wheelhouse at CNR as much, but I'm hearing a lot of buzz now around this new initiative of maybe having more private markets investments inside of 401k plans. I mean, that opens up a whole other avenue, right? Yeah. In terms of the investment world. So it's just so, I think, important to stay on top of it. If you're a listener, stay in touch with your advisors to make sure that you're, getting up to date on this, because it's changing rapidly, right?
Absolutely. I mean, we're big advocates of alternative investments in client portfolios, especially for our client type, on the higher end of the wealth spectrum. There's a lot of opportunity to receive a higher return in exchange for volatility. We have liquidity risk. And so for clients that can take on a little liquidity risk, the opportunity set is much greater for doing so.
Yeah, no, it's kind of a new frontier for sure. Well, Eric, listen, I really, really appreciate your time today. Thank you so much for your expertise and all you guys do at CNR, and looking forward to having you on again soon. Thanks again.
Thank you, Eagle. Thank you for having me. It was an absolute pleasure. Thank you, Wendy. Great conversation. Looking forward to another one.
All right. Well, thank you both. Michael, how do people get in touch with you if they have some questions?
Sure. You can reach us on LinkedIn, myself, my father, John, Copper Beach. You could reach us on our website, www.cbfgllc.com. You call us on the phone, 856-988-8300.
All right. Well, thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available.
This material is for informational purposes only. Neither Osaic Wealth, Inc. nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Copper Beach is not affiliated with Osaic Wealth Incorporated. Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Additional advisory services offered through Copper Beech Financial Group. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors. Any opinion expressed in this forum is not the opinions of Osaic Wealth Incorporated and have not been reviewed by the firm for completeness or accuracy. Osaic Wealth Incorporated and Copper Beech Financial Group are not affiliated with any other named business entities mentioned.